Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market. You all know that drill. Smash that like button, subscribe if you already haven't. Just a little disclaimer. Nothing should be construed as financial investment advice, just my thoughts, my opinions on the markets, and just want to let everyone know this week was super hectic in my personal life. A lot of things going on. I'm not going to spill my personal life over, but I just didn't have time for a video. I actually did one on my sports channel, and that one day is why I did it. But I'm gonna try to do more this week. A big week coming up. So anyway, let's get into, as promised, I'm gonna go over all the economic data this week. I left off on March. You can go back to last video. I mean, it's up there. I think it's up there. But you can go back to last video if you forgot about March. Let's go to Wednesday. Where is Wednesday? So Wednesday right here, let's look. Mortgage applications, those are down 2%. Mortgage rate fell. It's at 6.71%. Durable good orders, that was 9%. Increase from 0.1%. That's good to solid data. And then GDP, that was the final growth rate, 2.4%. And that is for the fourth quarter, I believe. Let me just gonna go look real quick. I think that's fourth quarter of 2024. It's worthless now because it's the previous administration, so I don't think it's not forward looking. Initial jobless claims 224. Core PCE prices 2.6%. But pending home sales, that was 2%. That was actually a good one. I think that's just because of the lower mortgage rates. Kansas City Composite Index -2. That's negative. So the data looks okay. Here is the big one. Friday, PCE Index month over month rose by 4%. So inflation's getting hotter than expected, and this is really bad for the market because the market they're expecting even this is before the tariffs. The market's expecting more inflation, so that's why the market's coming down. Is because not only they're worried about the tariffs, but then they're worried about prices going. If they're already high as they are, once those tariffs come in, they're worried about that. So year over year, 2.8% instead of 2.7. Now remember, I think inflation's much higher than reported. I just use these as a trend watcher. That's what I use. I don't really use them as real. And of course, consumer sentiment in Michigan, 57, below expectations of 57.9. The consumer sentiment's horrible. Next week we'll have some data, Chicago PMI and everything, but this is okay data, but the markets are more focused on the tariffs and everything, and they're actually ignoring a lot of the bad things in the economy, which I think are going to occur. But let's get into a couple. I saw a couple of things. Want to get into this, and this is basically where is this? Why Wall Street is talking about a Mar-a-Lago Accord as a way to understand Trump. So I'm not going to talk about Trump too much, but this article shows how out of touch and delusional people are, and just about what America is, what made it prosperous, if it ever was prosperous. I don't know. I'm beginning to think that a lot of this stuff, of course. Now I can't. My computer won't. Yeah, Yahoo Finance. People can't read, so they have to. Now I read this a couple of days ago, so I tried to So here it is. This is the biggest myth. I'll say the goal is to ensure the dollar remains supreme as global reserve currency, while at the same time correcting what is viewed as an overvalued dollar that makes the US manufacturing less competitive. A strong dollar would help because that means land prices, property, all that compliance would actually be low. And you could buy them with cash. You don't have to buy them with super high you don't have to buy them with high interest rates, which cause more costs. So this is why, it's going to fail, this bring back manufacturing, because it's built off a failed premise, and that's the overvalued dollar. A strong dollar is actually good. We were on a gold standard when we had a big manufacturing base. So, and we also did have tariffs. Tariffs are actually good because it helps bring things back and over time brings wages. But the countries he's targeting, Canada and Europe, that's not why we have problems. So, more stupid people that don't understand reality. So, anyway, so here it is argued that convince countries to help with the devaluation instead of security guarantees. Great. More petrodollar agreements. That's not what our country needs. Or pledge to drop punitive tariffs called multilateral approach. So, in order to weaken the dollar and strengthen your currency, they're going to be winning. They get a stronger currency, weaker dollar, and no tariffs. So, not only that, they get to make goods anyway, and the U.S. won't bring it back any manufacturing. So yeah, the only thing we have going, meaning America, is that it's unclear where countries would go willingly. Because countries, they're not smart enough to take this because they're going to be gaining everything. They're going to get to manufacture all the goods, and they get a stronger currency. And because our leaders are dumb enough to think a weak dollar is all we need to have a manufacturing base, well, that's so. There it is. Uh, I just thought this was interesting. So it's all about undervaluing foreign currencies. And so when I looked at this, I was just laughing at it. I thought it was sort of. So my view is a country on which we are imposing these tariffs ultimately pays those tariffs, as opposed to having any negative affectional consequence of the US or whatever. So here it is. Trump has suggested an openness to devaluation, acknowledging a campaign that gap between US and other currencies have created a tremendous burden. So this is their plan to bring back is just to destroy the dollar. So here it is. In recent comments, seemed amused that he was still being asked about the paper as he downplayed its chances in the near term. It's taken on a life of its own against all my interest. But hope perhaps springs eternal. Uh, at, with Moran adding of the currency side of the equation, could it be something that is entertained down the road? Sure. So there it is. And this is what I said. There's going to be a massive stimulus and a monetary stimulus. He's calling for zero interest rates, zero. Well, he's calling for low interest rates. I think really means zero or next to zero. And it's going to be a fiscal stimulus too. So here it is right here, Mar-a-Lago Accord. And I mean, I think this is going to happen when with the stock market, which has been going down. We'll go over. So more things about the economy coming. If you look at it, found this interesting. Recession is coming before the end of 2025. generally pessimistic corporate CFOs, not CEOs, not executive, but financial. These are CFOs. These are the people that are in charge of the books of all these companies. They're saying a recession is coming. And they're not basing it off macro or looking at, no, what are they doing? They're looking at the books of their company. They're looking at their assets. They're looking at their liabilities. They're looking at their incomes. They're looking at cash flow. And what are they doing? They're saying we're going in recession. So look at it. The economy will enter recession second half of 2025, according to majority of chief financial officers. This is a CNBC quarterly CFO survey. They generally describe themselves as pessimistic over the U.S. economy and uncertain about the stock market. All right, they talk about Trump, which I'm not really that big on the tariff criticisms or anything. Uh, so let's see more. Look at this. Pessimism has crept back into the animal spirits, Keynesian animal spirits, whatever that is. So, so there it is. But a lot of CFOs, I think his articles sort of junk. So I'm not going to go too much into it. I read it a couple of days ago. I've been so hectic that, but yeah, there it is. Most CFOs, I mean, they want to blame it on Trump, but I think the real truth with this is they're looking at their books, they're looking at the economic activity, they're looking at all the stuff, and they're saying, yeah, we're going in recession. Now, we're going to do an auto loan update. This is something I talk about. And I don't know anyone else, but U.S. car repossessions rose by 16%, hit 1.73 million in 2024, the highest since 2009, the last year of a great financial crisis. So yeah, auto loans. Now I paid off both, my auto loans and my family. I paid them all off when gold was at 3,000 because I know this type of problem is going to start occurring, and I don't know how it's going to impact my auto loan or whatnot. So I wanted it out of the way. Gold hit 3,000, one of my targets to empty a little bit. I don't think it's the end of the bull market, but I think, as I say ad nauseum, 50 is the next target. Let's see. So car repossessions means a lender legally takes back a vehicle from the borrower who has defaulted on their loan payments. And I wasn't sure how all these things were exactly done. I don't know if it's what assets or whatnot. One of the car loans was really a bad deal, so I wanted to just get rid of that. So look at that. Americans fall behind on car payments. Look at that. Now it's 6.6%. It's really going up. And look at this. This is just going non-linear and fractal in nature. You can see it just, if you look at where my mouse is, it keeps going. And I think it'll go up to 8%. So look at this, higher than around the great financial crisis and right before the tech bubble. So look at that. Auto loans, serious delinquency rates hit 3%, the highest level in 14 years. So yeah, the auto loans, this is going to be a problem. I think this is one of the reasons, they always blame it on Trump tariffs. They're not going to tell you the truth. But I think this auto loan problem is one of the reasons the stock market's starting to decline. Because these automakers, this is one reason manufacturing won't get back. When you mass fire people, they have auto loans. Auto loans might be the first to go, especially with return to work office and they're taking public transportation or spending all, they might just default on their auto loan. And they'll be like, well, the only thing we don't lose the credit card, we don't lose ability to borrow, they just repossess our auto loan and it hurts your credit score. So I think the auto loans is the first, and that's really going to hurt. And a lot of these cars, they need capital for manufacturing. But if you have these defaults on the auto loans, they're not gonna have the capital to bring the plants, to move the plants back here. And so as a result, they just keep the plants where they are. So anyway, auto loan bubble, this is getting serious. The housing bubble, which we talk about on this channel, never heard about it. Home builders face muted spring selling season amid. Now they say tariff uncertainty. I don't buy that. They used to say election, but this time high mortgage rates, I do think that has something to do with it. Most U.S. consumers are up to their eyeballs in debt. High interest rates, they can't afford those. So, and it's cheaper to rent. So, look at that rough start to the. Look at this. KBH, this is a home builder, 17% drop in net orders from a year earlier. So look at this selling price. This is what I want. From 2025, dropped to 480,000 instead of 495,000. An expected range of 488,000 to 498,000. So you can see they're starting to lower prices on the housing market. So yeah, there it is right there. Prices on new homes. Not only that, if these new home prices are going to be very low, why would you buy a used home? There's no point. So average selling price down to 480,000 to 495. It was expected 488 to 498. So prices are slowly but surely coming down. So there it is. More housing market updates. And just the economy. I think this just goes to show how bad the economy is. I don't know if any of you heard of it. It's a big bar where I'm from. I don't even think it's that good, the food wise, but I do think it has a great variety of drinks. It's a social place. Bar Louie closes more than a dozen restaurants, files for Chapter 11 bankruptcy. Now, I'm not a bankruptcy expert, I'm not an advisor, so just disclaimer, but the truth is, Chapter 11, from my understanding, is a reorganization. They wipe out the creditors, and Chapter 7 is when you're bankrupt, you're going out of business for good. So this is more of but it shows how bad things are. Where they filing for Chapter 11 again. So this is only one time, so it's a reorganization. But look at this, various financial and operational challenges. Now, even though it's a reorganization, that means creditors they're getting they're getting wiped out. Someone's losing money on this. Someone on the other side is losing. So yeah, someone's losing. This is gonna hurt. Uh, Look at this. Closing 13 corporate-owned locations. Lists 48 currently on its website. So it's not just so those are jobs. Look at this. Inflationary pressures have caused consumers to cut back on dining out. So there it is. At the same time, menu prices have risen to keep pace with increased food, utility, and labor costs. So people are eating less, but costs are going up. So they can't make up the lower margins in volume. Estimated assets of 1 to 10 million, with estimated liabilities of 50 to 100 million. Largest creditor is U.S. Foods, which is owed more than 1.8 million. So as you can see, yeah, this is a lot of people, a lot of losses. So, and it's not just this. Earlier this month, I've covered this on the border. I covered this, and not only that, TGI Fridays, Red Lobster. Uh, yeah. So this is going to hurt. More bankruptcy to come, and last article, let's just thing I want to talk about. Like gold surges past 3,100. I don't know where it is now, but this is what I thought. These were Wall Street estimates. Bank of America predicts that metals will reach 3,500 over the coming 18 months. So there, that's that. And then Goldman Sachs says 3,300. Well, I tell you, Wall Street loves gold right now. So I think it's due for, some sort of pullback. Let's go see where gold is right now. I think the Kiko could be showing futures. I hope it's actually just at zero. So, oh, great. It's only 190. So, this is after hours. Of course. Why can't they just go on and have the prices immediately? No one reads Kiko for its content. They have the YouTube channel, and that's what people go to. But let me see. All right, good. All quotes. This is good. I know how to buy gold. So right now it's 3,084. So at 50 cents at a dollar. So it closed at 3,085 and 70 cents. And so it's around $3,085. Who knows? As I said, it could just go sideways for a while and then go up. It could go way down to 2,600, which I'm sort of rolling out, and then go way up, or it could just chop, go down to 2,800, and then make its final move up to, 3,500, maybe to 4,000. And so that's why, what I say here, silver 34.17 breaks 35, breaks 38, will quickly go to 50. And I think that's so I would say, in my opinion, is looking at the Huey Gold Bugs Index. If you see silver at 50, let's see, where's the Huey? Of course it can't go. Great. So the Huey's at 359, and let's just do an all. And let's say this was 598, but let's say the Huey's around 500 and silver's around 50. I think that's a time to have, in my opinion, not financial investment advice, hedging in, or at least some minimum automatic sell orders if things get bad, because that could be a sign. You see these two, and let's say gold's at 35, 36, or 4,000. We could be coming to a very big top. So, because you have to remember, gold was at 2,000 last year. If it goes up to 4,000 or 35, like that's quite a move. And done over a series of, 16 to 18 months, that's a big upswing. So that, yeah, that's my opinion. In terms of the stock market, let's see where the stock market, let's go to the S&P. The S&P, this includes the Dow and the Nasdaq. On a 5-day, this went 295, 2.95%, over the week. And you look at it around, it just started going way down. It looks, even year to date, it's down 5%. Even a yearly basis, it's still up. But as I said, I think at most it has one more run. I think when the big monetary and fiscal, it could do a final upswing. But in my opinion, the bull market that began in '09, I think if it's not over, it's almost over. And it's possible it's already over. So it could. But yeah, if you look at this year to date, that's down 5%. We'll just go 1 year. If you look at it, the top was around February. That's 6,129 at least, or 144. And now this is almost a 600 point decline, give or take some. So This is a big, and if you look at it 6 months, it's down 3.5 or 3.15%, 5.11. So stock market, let's see the CNN Fear and Greed Index. So yeah, still at extreme fear. So I think it will still come up and eventually get a bounce, but who knows? Maybe I think that bounce is over. It's come down, but it's going to come around fear and neutral and get a bounce. But yeah, that's all I have to say. Just looking out, we have a big week ahead. I'm going to try to do more videos this week. I had a very hectic personal life. So, anyway, that's all I have to say. Hit that like button, subscribe. If you've listened all the way through, thank you very much. It really helps the algorithm. And I'll see you next video. And just remember the disclaimer, not financial advice.